here. It is indeed my pleasure to be here speaking in front of the International Association of Financial Engineers audience. As David said, these are my own personal views. They don't represent the views of the commissioners or staff. As you can see, this is a paper with three other co-authors, two of whom are, or all of them are actually associated with the Commodity Futures Trading Commission. So the Commodity Futures Trading Commission is a relatively new regulatory agency. The agency was created in the 1970s, in 1975, unlike its sister agency, Securities and Exchange Commission. And some people think that the agency was created in response to something called the Great Grain Robbery. So what was the Great Grain Robbery? In the 1971, 1972, after Richard Nixon's visits to Russia and China, where he signed free trade, some form of free trade agreements, and greatly encouraged the Russians, in particular, to buy U.S. wheat. It was sort of a difficult year wheat-wise for Russia, and so Russians came to the United States and bought about a quarter to a third of wheat without really anyone knowing that that's what they were doing. Subsequently, it was discovered when the prices skyrocketed. And there was a question asked, there was a public outcry, and the question asked, why isn't somebody watching this? How come we have this situation where we have limited supply of a very important agricultural commodity, and nobody's paying attention to this? So a function that was previously allocated to the U.S. Department of Agriculture was taken out and created as a separate government agency. So it's an independent government agency that reports to Congress, just like Securities and Exchange Commission, only reports to a different committee. And in the story that I just told you, there is also a bit of a underlying theme that's related to financial crisis, to regulation, to rulemaking, to creation of new agencies. There's some events, some liberalization, some opening up. There's a reaction to it, and that reaction is followed by some sort of a need for new regulation. So what we're going to look at today is a very peculiar event that happened on May 6, 2010. That was subsequently called the flash crash. And the flash crash was a very sort of extreme movement in prices that took place over a very short period of time. In the course of about 30 minutes, all major stock market indices, U.S. stock market indices, went down about 10% and then bounced back up. So subsequently, people asked the question, so what happened? And a survey was conducted by a company about a month and a half after the event happened, and 80% of U.S. retail advisors at the time said that what they think caused the flash crash is over-reliance on computer systems and high-frequency trading. So they think high-frequency traders are the ones who went in and did something to the markets on that day that completely, de-anchored, the prices were ever anchored, completely de-anchored the prices, and then prices bounced back up, driven by presumably some return back to fundamentals. Why would people think that way? Well, things moved very fast. There was no underlying really fundamental reason for things to move that fast. There was a lot of already bad feelings, for lack of better words, towards highly, very fast traders in the market. And naturally, people thought these are retail advisors. Remember, so these are the folks who interact with retail customers. These are the folks who interact with you, and your wife and your grandma, who would tell them how to advise on stock trading. And they said, look, it's not us. It's not something that, and we don't think it's something that is really anything wrong with the markets. It's this fast guys. Fair question. So what we wanted to do is to find out exactly what is it that may have happened on that day and whether or not high-frequency traders are to blame. So what we at the CFTC have something called audit trail data. So audit trail data is all transactions during the day for all market participants who trade in the markets that we regulate. That is exchange-traded options and futures. We also have end-of-day positions of all market participants. So we have the entire transaction profile, and we have end-of-day positions. So presumably, we could be in a position to say something about if there's some particular trader, group of traders who've done it. So the three questions that we asked are, what did high-frequency traders and others did on May 6th? What may have triggered the flash crash? And what role did high-frequency traders play in the flash crash? Our findings are, just for those of you who may need to leave early or just want to see what's coming, is that high-frequency traders did not cause the flash crash. On May 6th, high-frequency traders traded about the same way as they typically do, and I will show you what we think they do on any given day. They take very small inventory. They don't trade. They don't accumulate, significant inventory positions. They trade through a lot of volume, and they basically take more liquidity. They're more aggressive and passive. What we also found is that a large but very short-lived imbalance occurred between those fundamental sellers and buyers, those who actually come and establish a directional long or short positions. And that fundamental imbalance had to be picked up by somebody. And there was a group of traders who picked up that imbalance. This imbalance was picked up by a group that we call opportunistic traders. These are traders who would pick up an imbalance in return for a price, and then would try to hedge this imbalance in other markets, in particular in the spider, in the basket of securities. And that imbalance was picked up in return for a massive price concession, because fundamental buyers were just not in the market at the time. And eventually fundamental buyers stepped in, but they stepped in miraculously after trading was paused for 5 seconds, so that we will return to that. So that's what we found out. And the way we went about it is we looked at something that we have the data on. We looked at the mini S&P 500 stock index futures contract. This contract is really one of the best ways, so people say, is to gain exposure to the US or global stock market, if you will. So this is an electronically only traded futures contract. It's traded on the CME Globex pretty much around the clock. It boasts the highest dollar trading volume among US equity index products. It contributes the most to price discovery according to some of the research done. What that means is that if people want to, if people know something or would like to trade on some view, that is where they typically take their trades first. That's what it means, contributes the most to price discovery. And price discovery typically occurs in the front month's contract. On May 6th, the front month's contract is a June contract. So this is a picture of what happened on that day in May 6th in the June 2010 mini S&P 500 contract. The blue line is the price, and the red line is volume. So something really quite peculiar happened on that day. It was an unusual day to begin with. It was a day when, in the beginning of the day, there was a lot of uncertainty about Greece possibly declaring default. Various packages were being pulled together. You could see a flight to quality in the beginning of the day and sort of throughout the morning. You see yields on U.S. Treasury bonds going down. You see the gold futures going up. You see the carry trade between the euro and the yen, and dollar and the yen sort of being unwound. You see all of those signs of sort of flight to quality. People are, investors are across the board rebalancing their positions. Across the board, we have higher volume. You have about twice the normal volume. You have prices moving sort of in a predictable direction in various instruments. In this case, in the E-mini and other stock market indices, prices were down about 2%, give or take, by about 1:30 Central Time, or 2:30 Eastern Time. 2:30, mind you, is not that far from the end of the day. And so at that time, something suddenly happened. Volume spiked up, and prices dropped and recovered. So spike went up and down, and prices dropped and recovered. So typically we would think of volume going up as something positive, as something that's associated with good liquidity. In this case, you can see that, probably it may not have been, it may not have, it's not really clear what really happened. So one way to, this is just a way to sort of present this, what I just said, in the form of a table. It was an unusual day, it was about twice the trading volume. The number of traders was larger. This is in the E-mini, again, current month's contract. We have about 15,000 traders on May 6th participating. Trade sizes are about the same, order sizes are about the same, or 10 lots, 10 contracts. Limit orders as percent of volume, slightly smaller, but still pretty high. Volatility is obviously is much, much higher than the 3 days prior to that. So we have over 15,000 different traders trading in that day. We have execution profiles on that day, on the previous days, for all of these people. But 15,000 is a large number. So can we think of putting them into groups based on their trading behavior? That would be sort of, that would aggregate what they do separately, some idiosyncrasies that they have separately, but would be broadly consistent with what we think their patterns are. And that's what we did. And the categories we came up with were high frequency traders, intermediaries, and I'll describe to you how we came up with them, fundamental buyers, fundamental sellers, opportunistic traders, and small traders. So we used two criteria to come up with this classification. And this classification is ours, right? So traders don't come into our market wearing a tag which says who they are. So we have to come up with a name and based on their trading strategy. So we allocate them based on their trading strategy, and of course, there are probably other ways of allocating traders based on what they may do. So these are the categories that sort of make sense to us. And the first two categories, high frequency traders and intermediaries, are the category that we call broadly market makers. So these are traders who fluctuate around certain level of inventories throughout the day. So that level of inventory doesn't necessarily have to be zero, but it's close to zero. So, and they would go a bit above it and a bit below it, so you can see them reverting to the mean quite frequently throughout the day. So they're there, they're trading a lot, but they're staying within a certain inventory bound. So the criteria that we use to sort of separate them into that category is their net exposure and their net exposure ratio of their net exposure to the trading volume. Fundamental buyers and fundamental sellers typically establish a directional position, so they may not necessarily only buy or only sell during the day. They may both buy and sell, but at the end of the day, they end up net long or net short a large enough amount, large that we determine to be large. Opportunistic traders, small traders are the ones who trade 9 contracts or fewer, and they trade in a basically unpredictable, erratic way, in a way that we can't really say anything about. And we picked 9, we could have picked 10, we could have picked 20, but one contract, one mini contract at this level of the index is about $55,000. So 10 contracts is about $500,000. So 20 contracts is about $1 million. So if you calculate sort of a reasonable margin that you have to pay on this, that to us seemed like, if we're talking about small traders, retail investors, those who just come in and buy one contract and do nothing else, it's a reasonable cutoff point. Opportunistic traders is everyone else. So once we have fundamental buyers, market makers, and small traders out, everyone else is opportunistic traders. So these are the guys who run cross-market arbitrage. These are the guys who run momentum strategies. This is all possible other strategies. But the way they look to us in the data is that they would sometimes accumulate a directional position, and then would trade around it, and then they would reduce their directional position. They do not seem to be targeting any particular level. They seem to be doing something that, whatever it is their strategy drives them to do, but they don't like to end the day sitting on any particular large exposure. So by the end of the day, they are sufficiently below what we would call a directional exposure. So these are our categories. This is what we came up with. We aggregated our participants into these categories. This is sort of a picture. So what you have, what you see here is that, imagine that we've taken 15,000 accounts and we rank them from highest to lowest in percent of volume and in percent of the number of transactions that each account accounts for. And then we plotted this ranking, but because we can't really show you what each particular account does, we've sort of drawn these shaded areas around where these accounts fall. And this, what you can see here is that you have high-frequency traders, just a handful of accounts, just 16 accounts, who really stand out. Then you have intermediaries right below them. Then you have fundamental traders, these guys. And then you have opportunistic traders sort of covering the area between them. The way we think that we're able to, this picture lays out, the way it lays out is that we think that high frequency, or based on what we've done, we think that high frequency traders are qualitatively different than other traders. In fact, we think that at this level of speed at which they're operating, they're pretty much deterministic. Again, and I use high-frequency traders as literally to define those who have the highest frequency of trading, the top 3 to 5% of market makers, which is we designated as high-frequency traders. There are other, remember this is an electronic-only market, so all of the trading in this market is done by algorithms. So these are not algorithmic traders per se. So pretty much all of this, but maybe small traders, are algorithmic traders. High-frequency traders are those with the highest frequency. Then you can also have momentum algorithms, automated execution algorithms, all sorts of other algorithms. So high-frequency traders stand out. We think the way they stand out is because they really run almost deterministic strategies, and I'll show you what we think the strategies are. The market makers are slow. The intermediaries are slower than high-frequency traders. So intermediaries and opportunistic traders, because of the nature of their strategies, would overlap, and they do overlap. Fundamental traders typically are the ones who do not want to have a large market impact. They're the ones there to establish a position. So they would try to, and that's where they fall on this graph, they would try to actually position themselves as close as possible to noise. They really want to pretend like they're not even there. That they will subdivide their trades, they would execute in a way that you cannot detect them. And that's where you see how they sort of overlap here. They try to get close to noise, but sometimes they would, since they're accumulating in directional position, they could also look like opportunistic. So this picture makes a bit of sense to us. Some summary statistics for this participant. So the top panel is, we took the top panel, the MACE 3, 4, and 5, and the bottom columns, which is supposed to represent sort of normal days. And the bottom panel is MACE 6. And one of the interesting things you can see here is that a very small number of high-frequency traders accounts for about 30 to 35% of trading volume, which is quite a remarkable number. So you have a fully electronically traded contract, extremely liquid. The matching engine is price priority, time priority. How do you get to be 35% of trading in this contract? This is an enormous number, right? And just a handful of accounts do that. Also, what I'd like you to notice is that if you look at fundamental buyers, again, our categories, and fundamental sellers, then together between the two of them, they account for about 20 to 25% of trading volume and number of trades. What that means is that 80% of trading in this market is intermediation at different levels. So it's just, could be at a very high speed, it could be at a slower speed, it could be within milliseconds, seconds, maybe minutes or hours, but it's intermediating, it's splitting those contracts that really these fundamental guys who are coming here to establish this position to this market, which are the positions that they bring, is being intermediated through the market before it finds home somewhere. So that is, again, a very, at least to us, and somewhat of an unusual or somewhat of a revealing number that you have such a great degree of intermediation, and also that 30% of this volume comes from a handful of accounts. So what are the net holdings of high-frequency traders? So how the way we do this is that these are minute-by-minute calculations. We just look at them as a group. How much do they hold in the beginning of the minute? How much do they hold at the end of the minute? We start them at 0. We think that it's a reasonable assumption to start high-frequency traders' net holdings in the beginning of the day at 0. And we'll look at their evolutions throughout the day. And as you can see, they basically cross that 0 line many, many times throughout the day. And they rarely go anywhere above or below 4,500 contracts. So just very rarely. That's an unusual, very unusual number to them. So that is an important number to keep in mind for the rest of the story. Another interesting part to it is that you can see that the black line is prices, and the red line is net position. If I were to remove the black lines or scramble around MACE 3, MACE 4, MACE 5, and MACE 6 and ask you to identify MACE 6, you probably wouldn't be able to do that. Because it doesn't look like on MACE 6 they did anything drastically different from any other day. It looks about the same. They're just trading a lot. They're bouncing between the floor and the ceiling. They're crossing the 0 line quite a bit. There's, it's really hard to say that they really changed their strategy in any fundamental way. And that largely is going to, so this picture is largely going to be, subsequently, part of the analysis is going to confirm is that high-frequency traders did not change their trading behavior on that day. So anyone who claims that they caused something, this contradicts this claim. They did what they usually do. So what about the intermediaries? What happens to the slower market makers? Slower market makers, as you can see, have quite a bit of a different pattern. Slower market makers tend to get run over by price moves. So this is your sort of general curse of being a liquidity provider, is that if prices move directionally for a period of time, and if they do it fast enough, you can get caught on the wrong side. So you can get caught on the wrong side here, can get caught on the wrong side here. They got caught on the wrong side here. You get caught on the wrong side here. So that is a very different pattern compared to high-frequency traders. Also notice that scales here are also smaller. So intermediaries, while they do get run over, they don't go above or below, pretty much 1,500 contracts. So they try to stay pretty close to zero throughout the day. What we then try to figure out is to say, look, this is what the high-frequency traders seem to be doing. What is it? What sort of strategies do we think they follow? So what this equation represents is that you can think of delta y is their holdings. So their holdings, second by second holdings, and they adjust their holdings. So we know that they bounce around some target, let's say around zero. So they mean revert to this target. So they will be. The change in their net holdings at any particular time is going to be related to the change of their holdings second before that. It's going to be related to the level of their holding, which is y, and it's going to be related to what the prices are doing. So the price, depending on where the prices are going, they will be either accumulating position or reducing a position. So we think that we should be able to capture in some way what we think that they're doing. How is it that they are? What is their rebalancing strategy around this target level? And what we found out is that high-frequency traders, pushed on their own. Right. Okay. So on May 3 through 5, high-frequency traders trade in the direction of the price movement for the first 5 seconds. So it is quite remarkable. They're either able to predict where the prices are going, they're just that good, or they're able to predict liquidity movements and trade in front of them. So they trade in the direction of the price movement for the first 5 seconds, and then they trade in the opposite direction for 10 seconds after that. So think what this says. What this says is that they buy right before the prices to go up, and then as prices went up, they sell. They sell right before the prices are to go down, and then as the prices go down, they buy. It's beautiful if you can do this. What about on May 6th? On May 6th, they do about the same thing, only just a little bit faster. And you can see why it could be faster on May 6th. It's about twice as fast. Well, the volume is about two and a half times higher on that day. Remember that the volume was 2.5 times higher on that day, but their proportion as trading volume didn't really change much. That also sort of makes sense. Remember, it's about 30%. You don't want to be at 50%, because if you're at 50%, you're going to be moving prices. You don't necessarily want to be at 10%, because at 10% means that you will be probably missing out on some of the action. So 30% also makes a lot of sense. What about intermediaries? What about their pattern? Same regression for them. What we find is that they trade opposite the price movement for the first 2 seconds, and then they trade with the price 3 seconds after that. So that explains to us sort of why, this is a sort of your classic market-making behavior where you're on the other side of the price move. That explains why you can get run over by price movements. They trade opposite the price movement contemporaneously on May 6th, and then they also, again, very fast try to rebalance their position on May 6th. So it's a similar strategy, again, increased. So what about profits and losses? Again, since we started their positions at 0, we can see what their inventory is. We could market to market, market to where the transaction prices are. And as you can see, this strategy generates very good profits and losses. First of all, they never dip below zero on any one of these days, regardless of where the prices are moving, up, down, left, right, a lot, not a lot. Unlike the intermediaries, who do suffer losses when prices move against them. Again, the scales here are also different. So you can see the scales here is millions. Scale here is, thousands for profits and sometimes millions for losses. What about provision or providing or taking liquidity? So the high-frequency traders, if you ask them, or if they participate or they give interviews, they say, we're providing liquidity. We're bona fide liquidity providers. We're just faster. We're there to serve the market, the market's needs. This is what we do. Well, in our data, we actually happen to have an exact flag for whether or not you are passive or aggressive when you trade it. So passive means that you had a resting quote and you got hit, and aggressive means that you hit someone else's resting quote. So exact flag, no guessing. We know exactly for each transaction who was passive, who was aggressive. So what we see is that high-frequency traders aggressively reduce trade in the direction of the price movement for the first few seconds, for the first 6 seconds, and then aggressively trade in the direction opposite the price movement after 10 seconds. And then they passively provide liquidity at all lags. So what that means is that remember that they're trading in the direction of the price movement aggressively. So aggressively, they trade and they push the price. Let's say they aggressively buy. They know that the price is about to move up. And then they slide in the quote right above it on the opposite side. So as the price moves, it hits them. And so that's what liquidity provision means in this particular case. So on May 6th, they do something very, very similar, pretty much the same strategy. I would be hard pressed to call it liquidity provision. It is something. It's doing something with liquidity. It's hard to say that it's actually providing it. Intermediaries, however, do in fact do exactly that. They are passive in the right direction, on the direction of against the price move, and then they try to go aggressive, but with a much, much smaller coefficient. Right, on May 6th, they have smaller coefficients throughout. So they do provide liquidity. They're the ones who provide those resting quotes, and on May 6th, they did less of it. So what about during the period of the flash crash? Can we say something about what they did during the, sort of those few dreadful minutes on the way down and on the way up? We see that high-frequency traders follow the same strategy. Intermediaries get caught on the wrong side on the way down. And on the way up, high-frequency traders are less aggressive. And there are other groups of traders who are more aggressive at this point, who are crossing the spread a lot. And intermediaries close their positions. In fact, many of them use market orders. They close them quite aggressively and got out. About half of them got out. What we also wanted to see is what about those fundamental buyers and sellers? So buyers and sellers here means fundamental. And again, they could be both buying and selling. So it's net buyers and net sellers, if you will. So we looked at the 3 days prior to the flash crash, the same periods of time, which are those 15 minutes down, 20 minutes up. And what you can see here is that high-frequency traders are balanced. Intermediaries are balanced. Buyers and sellers are imbalanced, but roughly in the same proportion. So these opportunistic guys are balanced. These guys are balanced on the other side as well. So you have an imbalance of about 5,000 contracts here, and you have an imbalance of about 5,000 contracts here. So opportunistic buyers and sellers are balancing each other out and everyone else is intermediating, churning through a lot of contracts. What about on May 6th? On May 6th, on the way down, there's a quite different picture. We have a situation where we have these guys are balanced again, but fundamental buyers are holding about 50,000 contracts net, and fundamental sellers have sold about 84,000 contracts. So where are those 35,000 contracts, and who's holding them? Opportunistic traders. Notice that on the way up, this is balanced again. So there's about 110 here and 110 here. So it's buyers again balancing out sellers. So in order to sort of for us to see what may have sort of happened and how it led up to this, what we've calculated is something we call cumulative aggressiveness imbalance. So cumulative aggressiveness imbalance will just accumulates throughout the day, aggressive buys minus aggressive sells for the whole market. And what this gives us is sort of an ability to see who is moving the market, which category of participants, because we could separate the cumulative aggressiveness imbalance for the market as a whole into aggressiveness imbalance for the participants. So again, these are aggressive buys minus aggressive sells. So if we separate them into groups of participants, when we run these reactions, we notice that high-frequency traders have a lot of impact on the price. Sellers and buyers try to minimize their impact on the price, which they would normally do. They would try not to have as little impact on the price as possible. Intermediaries have quite high impact on the price, and opportunistic traders as well. The fit of this regression is remarkably good, given that the prices are moving all around. So what are we trying to accomplish with this? We're trying to see for any given in any given size of a price move, a change in position of a particular group of traders, how much would it impact the market? So based on all of this, what I just showed you, here's what we think happened. And this is sort of the foundation of the flash crash report. What we know is that, and what the report that came out on September 30th said, is that about 1:32 Central Time, a large fundamental seller initiated the sell program. We also say in the report that it was the largest sell program of the year that was executed in about 20 minutes. The largest accumulation, largest change in that position of the year. So about 10 minutes later, remember high-frequency traders are let's just say, trading in front of this wave. They are discovering this wave when they're trading in the direction of the price move. That means that they are buying. And about 10 minutes into this, they reach their inventory level, and they turn around. They start selling, and they start selling aggressively, competing for liquidity with this large trader. This large trader is executing using a volume participation algorithm, so it's targeting volume. But now the volume is coming from 30% of the volume is now coming from market participants who are competing for liquidity with this large seller. At about 1:45, we have a situation which we call the hot potato, where basically there's only a fundamental seller and pretty much no one else in this market. And so the contracts that this fundamental, so the short position that this fundamental seller is injecting into the market start circulating very, very fast, spinning among the intermediaries. And intermediaries pass it on to each other like a hot potato for a price. I just picked it up. I just picked up 10 contracts. I really, really don't want it because there's no one. I'm not interested in holding. I'll give it to you. Tick down. You pick it up. No, you're not interested. You give it. You look for someone to give it to. One tick down, and this just starts going tick, 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 tick. At about 1:45:28, there's a 5-second trading pause. That's an automated trading halt that is initiated by the CME. And after that 5% trading halt, we have prices stabilizing for about 30 seconds or so, and then fundamental buyers come in and start lifting the prices up. Prices are at their 132 level by about 208. So in the report, to explain to you the report a little bit, just the background for this, the report has a lot of detail about what went on that day. We're talking about the large fundamental seller, we're talking about how many contracts were being sold, how the sell program was executed, how the cross-market arbitrage then translated this. Opportunistic traders, remember, are the ones who are buying from the seller, and what are they going to do with it now? They have to hedge it somewhere. Where do they hedge it? They go in the spider and hedge it, they go in the basket and hedge it, and so prices start moving down across the board. So we have all of this level of detail. The way we're able to bring out this level of detail is we are prohibited by statute from revealing information about individual positions or business strategies of market participants. And the way it works is that we are entrusted by the public, by you, with lots and lots of information. And you, the public, want to be able to protect it against us misusing or revealing this information that would hurt you. And so therefore, through representatives in Congress, you put in a provision in the law that prevents us from doing that. However, since these are your representatives in Congress, if Congress requests information that it thinks would benefit you, the public, it can do that. And that is exactly what happened. Congressional committees wrote to us and said, we would like you to put in the report everything that you think the public should know about this event. And that's how we were able to, this is how we were able to put in this level of detail into the report. Now, this is not everything that we know. We know a lot more. We know the exact execution patterns of every participant in this market. We know their positions. We know which algorithms they use from any of them. We know all of this. Now, this is not something that we felt would be necessary for the public for us to put in the report. I think that what the report needs to communicate, and this paper is sort of the analytical part that was behind the report, is that what we witnessed in these markets is a situation where we had a trigger event that happened to take place in the mini. It could have taken place. We actually examined a number of trigger events. There are many other candidates. There are several other candidates of trigger events. Somebody may have tried to put in, there were some instances of very interesting, or reports of some very interesting order submission patterns in individual securities. So we looked at those. There were some possibilities maybe something happened in the spider. Some possibilities maybe there are liquidity replenishment points on the New York Stock Exchange that may have resulted in a dry up of liquidity. We looked at those. But the trigger could be anything. And then that trigger resulted in a cascading type event. So this volatility cascaded through the market, and at the end, some of the stocks were executed at a penny, some of the stocks were executed at $100,000. Liquidity dried up across the board. So what we put in the report is something along the lines that, or is consistent with the understanding that a trigger could be, many things could be a trigger. What we're interested in is, or what we're concerned with is the cascade, and how did it reach a cascading type of a strategy. And high-frequency traders did exacerbate this cascade. They turned around, they did what they typically do. But they reached their inventory level, and they turned around and started competing for liquidity. And since they account for a lot of volume, and the algorithm targets volume participation, now we have a situation where we have a market moving away from the algorithm, and the algorithm is chasing it down. Just to sort of remind you, I don't know if you remember, in 2003 there was a big power blackout that affected New York City that affected about 50 million customers in a bunch of states all the way up to Canada. I don't know if any of you actually, the government came out and actually issued a report, also a joint report, only not joint SEC, CFTC, but joint US and Canada. And I actually looked at that report just to see what was the trigger for that. Did any of you know? Do any of you know what the trigger was?
Yeah.
What was the trigger?
Yeah, there was a utility, and I think it was somewhere in the Midwest, had to shut something down, and then the overload cascaded through the system.
Right, so there were untrimmed tree branches in the remote part of Ohio. Right, so untrimmed tree branches happen. It's like trees grow and they get untrimmed occasionally. Now the important part is, what do we do so that untrimmed tree branches or something else, or some squirrel or boy throwing a stick does not bring down power in New York City? So that's sort of that is what we are trying to find out, and we were trying to see how different market participants react, or how different market participants trade, and how they're trading, which could be individually optimal for them, could translate into a cascading type event in this system. You can, some people call these markets a complex adaptive system. It's a complex system and it adapts to its own sort of interaction. And so it would adapt because strategies are designed to adapt to where the system is going, and that may result in complex adaptive systems are prone to cascades. So what are our conclusions? Our conclusions are that a large trade will always have an impact. What we'd like to not happen is that it may trigger a cascade, and we'd like to think really long and hard how that does not happen in the future. Volume, which a lot of automated execution and other algorithms use as a proxy for liquidity, when prices move in a lot, is really not a good proxy for liquidity because market participants start adjusting their strategy, and that translates into lots and lots of trading, even though liquidity is drying up. High-frequency traders did not cause the flash crash, but did contribute to the flash crash by doing what they typically do on any given day. There's a bunch of questions that remain unanswered, and which are very interesting questions. Why did it take so long for fundamental buyers to come in? Why wasn't the 3% price concession not large enough? 4%, 5%, why did it have to be 9%? Why did it take so long? How did this 5-second pause work? Why is it that all of a sudden after the 5-second pause we have a very different market than we have before the 5-second pause? And what sort of safeguards can we think of to deal with possible cascading scenarios like that? We have some ideas about this question. So about the pause, one of the things that happened after the pause is that the reopening procedure after the pause is the same as the reopening procedure in the beginning of the day. So it's an auction. So demands and supplies are aggregated, and the price is selected to clear the market. Now the important part, however, is that when this reopening procedure is signaled to the market, remember that in this market there are no humans anymore. It's algorithms battling algorithms. Humans are not there. This is fully electronic, highly liquid market. So what these algorithms would receive in their feed is that we're about to start a new day. It's a reopening procedure as if it's the beginning of the new day. So now the algorithms look at the risk levels, risk parameters, and say, we're starting a new day. And on this new day, look at the price, look at the historical levels of the E-mini. This looks like a great buy. Maybe we should go and buy. Why didn't you do this before? Well, because before, you are not monitoring this at this frequency. If you're a fundamental trader, you may not be trading a lot. You may not be looking at the levels, but if it's a new day, you have to look and you have to reset your parameters. Is that what really happened? Possibly. Possibly. That would give us sort of very good food for thought about in the future about what sort of smart sort of circuit breaker type measures to think of. Because again, the thinking is that we have to think about these markets from the point of view of algorithms that trade in them. And algorithms, unlike humans, can't see each other. They have to guess what they're doing. And they rely on much, much more limited information set. They rely on the data feed. That's what they rely on. And they have to see something in the data feed that would make them change what they do. And so if we want to change, if we want to coordinate some sort of a response, if we want to have some sort of a change to happen, we have to communicate to the market through the market feed so the algorithm adjusts. And that's where the thinking is sort of partly is now. Another sort of set of questions is, which I'm not a very good position to address, is why did the securities trade at a penny at 100,000? I mean, what is this? I mean, how is it that those orders got executed? The report says a lot about, based on interviews, about how we think that propagation happened. And what you can see is, and again, this is outside of the area of where I am even reasonably comfortable, is about, since I am the primary authors of this report, frankly, it was my colleagues, I should take some responsibility for what it says. What we see happen is that there are lots and lots of market participants who hold it together in return for tiny sort of amounts of money that they earn very frequently. So they're internalizers, they are routers, they are various computer programs. Again, it's like it's like movie The Matrix. You have this different human-like participants who are really computer programs who like do certain things, like the Oracle or someone else, right? So or Agent Smith. So they do something very, very specific and peculiar, and there are times when and they get paid for doing that. But there are times when these programs are programmed not to do what they do. And so when that happens is that the program basically has tolerance levels, and when it says, oh, prices are moving too much, I'm pulling out. And when that happens across the board, basically this fragmentation in markets becomes very evident. So it becomes very evident that there are multiple trading venues. It becomes very evident that routing and internalizing is a service that is sort of built on top of very fragmented marketplace. And that is something that I think is receiving a lot of attention now as we're working in the aftermath of this event, which we're taking very seriously. Again, we're taking very seriously the fact that we view it as an opportunity to understand better what's there and how we could think of measures that are appropriate now, not after 1987 where it was mostly humans, but now when algorithms are trading with each other, to prevent the cascading type event. Thank you. Are there any questions?
There's the NYMEX report that had some different conclusions. Can you comment on the comparison of the two reports?
Which parts? There's several things in there.
Okay, that's fair. Specifically, here you're saying that HFTs were not directly responsible in NYMEX's. My read is that it's reached pretty much the opposite conclusion. I figure it's much less stable than that.
Right. So the main difference between our analysis and NANEX's analysis, and we worked closely with NANEX through this. And I really, you know, just as a disclaimer, I really appreciate the fact that they devoted their time and attention to this. I think it's a great public service that they provided. And they spurred a lot of the discussion, which we're thankful for. The main difference between our analysis and NANEX analysis is that we have execution profiles of all participants with identities of traders, and we can match them exactly to what they did. Whereas NANEX has access to market feed, and it has additional access to automated execution profile of the large trader that traded on that day. Based on that, it's not entirely clear just from that. In fact, it's very unclear by looking just at that what actually happened on that day. In fact, you know, the very first report that came out on May 18th, the preliminary report that we issued. I should tell you that 48 hours after this happened, we sort of knew a lot of things. But we looked at the execution profiles, and it was not just by looking at the few execution profiles, you really would not be able to tell what's going on. Because, for example, the automated, you know, this was a large cell program, but it was executed through an automated execution. So automated execution is designed not to make price impact. So it's designed to sort of not do that. But what also automated execution programs have embedded in them, as we learned subsequently, is that they typically take market as given. So they don't, when they execute, they don't account for the fact that they're making the market impact themselves. So if you're executing against, you know, VWAP or time or against volume, typically these algorithms don't calculate which portion of that is theirs. And on that particular day, if you actually look at executions and the market reaction to these executions, you can see that what would happen is that this algorithm, without knowing, starts moving the market and then starts chasing it. And you can't quite see it by just looking at the portion of the data. Now again, having said that, I was really quite excited when NANEX first came out with those very interesting order submission profiles in individual securities. I thought, this is great. This is the smoking gun. This must be it, because you know, this really looks quite promising. We did look at them. We constructed limit order books, depth for all 500 securities, with depth and the mini. And yes, if you look at the dynamics of depth, yes, there's some individual securities which have peculiar order submission strategies, but if you look for the 500 stocks as a whole, or even a large enough subset of them, it's completely drowned by the rest of them. So it's just not there. It's a beautiful hypothesis. It just didn't play out. It would have been really quite remarkable if someone could go and spoof the market into a 9% drop and recovery, right? But it just didn't quite play out that way. There were other hypotheses that we've also looked at that could have been possible triggers. And it doesn't mean that they can't be. Another hypothesis is, again, NANEX thought is that someone may have interfered with bandwidth. So someone may have really clogged up the bandwidth. So it was a high volume day already. So you have a lot of orders submitted, modified, and canceled. You also have a lot of orders being executed. So what if there is a possibility that on a particular occasion someone really figures out that we're about 10% away from the bandwidth maximum and really jams it? Again, didn't play out.
Hello. Yourself in your presentation, you talk about aggressive orders and conservative orders. Can you comment on NANEX assumption that liquidity providers do not have a market impact?
Well, by definition, I don't know if that's what they say or not, but the large seller was a liquidity taker. So when you come in, you don't provide, those who provide liquidity are typically market makers. They provide liquidity to you. When you come in to establish a position, you take liquidity from the market and hold on to it, right? So I don't know if that's what was said or not. If you look at
This I can add a little bit. The distinction they make in between liquidity providers and liquidity removers or takers is not based on is somebody accumulating a position. It's based on do I
hit the resting quote?
Or
Okay.
am I hitting the loop? On yourself, you also make this distinction between hitting the loop and residing in the loop.
That's exactly right. Right. So as I said, we have the exact flag of who was resting and who was passive and who was aggressive, right? And so the large sellers as a group were more aggressive on the way down than on the way up. Large buyers as a group were more aggressive on the way up. High-frequency traders were a little bit more aggressive or somewhat more aggressive on the way down and less aggressive on the way up. So as a particular, the way this automated execution algorithms work is that they have a certain execution profile that they have to accomplish. And typically the way it's done is that an execution is profile, sort of certain quantities that need to be executed is built ahead of time. So let's say a customer comes in, selects a particular execution profile, and for that execution profile, the black box, the algorithm builds a profile of what it plans to accomplish, and subdivides this profile into intervals of time over which it has to accomplish it. So if it wants to accomplish it over 3 hours, it's going to subdivide it into seconds and try to trade somewhere within the parameters of that. So when it's doing that, in order not to have a market impact, the automated execution algorithm will try to be as passive as possible. So the best way, if you want to sell, is to sell on upticks. So whenever you have upticks, you will try to sell. If you want to buy, you will buy on downticks. So what you will try to do is that you will slide in your quotes and you will wait for the market to come to you. And that way you don't get discovered, and you also accomplish your target, your execution profile. Right, so if, however, this execution profile is lagging behind what the target is, the automated execution algorithm would start adjusting prices on those quotes to become more and more aggressive. They don't necessarily immediately have to cross, but they would become progressively more aggressive. And if the prices start moving away, it's going to become more aggressive. Because remember, the customer tells the automated execution algorithm that they have to accomplish a certain profile. The algorithm is not going to complain and say, look, but the prices are moving. It has to do what it has to do. So as the prices start moving, it will start becoming more aggressive. And that's what we see in the profile. So we see once we subdivide the profile into passive and aggressive, it sort of follows the pattern which is consistent with the typical working of an algorithm, where it tries to be as passive as possible for as much as possible as it can. But remember, prices are going down on that day. There are very few upticks, if any. So in order to accomplish its target, it has to go aggressive. Now, when prices start going up, the execution algorithm did not stop. It only executed a bit more than half of its target, and when the prices were going down, and about a little less than half when the prices were going up. So it was buying when prices, it was selling when prices were going up as well. So you can see that it could be a lot more passive when prices are going up because prices are ticking up. So it's consistent with what we think this algorithms are doing. However, in order to sort of make blanket statements of this sort, there are a lot of things that need to be understood about not just how the prices look like and how execution profiles look like, but against also about the workings of these algorithms. I hope I answered your question. Or at least communicated that we've looked into it long enough and hard enough before we said that.
Yes, you did answer my question. It strikes me that Namex is saying that this algorithm never hit the book and only provided liquidity and did not trade on the way down, while you're saying something else.
You touched briefly on the phenomenon of self-organization in a complex adaptive system. In this context, what is rough estimate of the probability of occurrence of the same pattern in a system like ours over time horizons?
Right, a very good question. So another way of putting it is this: can this happen again? Yes, this can happen again. Remember that, for roughly about $2 billion worth of the mini was sold when the prices are moving rapidly down. $2 billion is not a large amount of money for a lot of asset managers. Hundreds of thousands of asset managers have $2 billion at their disposal on any given day. So that is really quite disconcerting. Now, that sell, however, again, was a very unusual sell. That was, as I said, that was the largest change in net position of the year, executed over 20 minutes. We did look at other occasions of a similar accumulation of position. And typically these sort of level of net exposure is accumulated over 5 to 6 to 7 hours. This was also happening on the day when markets were already quite rattled, when there was a lot of already uncertainty and volatility. Also happened towards the end of the day. So this large execution program was executed at the very end of the day, which is quite unusual as well. If you want to execute a position of this size, you typically don't want to wait, an hour before market closes. So I'd say that one of the things that we are trying to do, and that's why we went to such great lengths, and that's why Congress went to did what they did to enable us to come out with a report like this, is that, and that's why I'm here, is that we're trying to educate the relevant public as much as possible about this, so that I hope that this event is now part of the scenarios in many, many institutions. This sort of patterns are now incorporated into what could happen for many different risk managers. So I hope that plays sort of a moderating effect. But in principle, yes.
The term flash referred to a sort of a microsecond, as I understand it, revealing of an order before the order is executed. And I may be wrong on this, maybe you could explain. To what extent was this a flash crash? Because you're not, when you say high frequency traders, you did not refer to this price revealing aspect of flash trading.
Right, so this is not flash trading, so the flash crash possibly refers more to the fact that it happened fast. But in these markets, there's no flash trading. No one can see the order flow before the order flow actually hits the market. So everyone trades with a black box. You can't really see it. However, you can see that trading strategies of high-frequency traders somehow can sniff out liquidity movements and trade ahead of them aggressively, in fact, and exacerbate that. So we've done some subsequent research on, which is not part of this paper, on the strategies of high-frequency traders, evolution of strategies of high-frequency traders over the last several years, couple of years, 3 years or so. And there's something very remarkable that's happening is that you see that they account for 30% of trading volume, a small number of them, right? So the way we calculate trading volume is sides. So every time a contract is traded, let's say one contract, we break this trade into two sides. And so if you now account for one side and I account for one side, And that's how we calculate our trading volume. So accounting for 50% of trading volume means you participate in all transactions. So, right?
Right.
So that's a lot. So proportionately, you would think that they would be bumping into each other a lot. And they used to bump into each other a lot, but they don't bump into each other much anymore. Because bumping into each other loses them money. They want to bump into fundamental traders. They want to bump into slower guys. They don't want to bump into each other, but they're churning through an enormous amount of volume. How is it that they don't bump into each other? How can that be? Right? That is very, very hard to do.
There must be some signal in the market that they have all
Coordinates
evolved
this activity.
toward. Right.
Yeah, so you mentioned that high frequency traders turn around in seconds, and then on that day you also mentioned that from 1332 the fundamental starts to sell, and until 1342 the HFT traders reverse their trading direction. And how does those two?
Right. So perhaps I should have paid a little bit more attention. So there was like one line on the slides about their half-life of their inventory position. So what happens is that the half-life of their inventory, I think, is something like 142 seconds. And so 142 seconds for half-life is about, it's on the paper if you want to see it. So that's about you would think that with that sort of a half-life, in about 5 or 6 or 7 minutes, they're going to be reverting completely to zero. And so if they're accumulating, so the two different statements are different. So they adjust their position in response to price movements. But suppose that there are no price movements. They would still adjust their position because they would be reverting to some target level. And so when we're looking at the target level, this is when they at that time, irrespective of what they were doing with respect to prices, because prices are just sort of moving around, they reached the level where they went to start selling. So that was more of a sort of what happened on their Y's rather than what happened on their P's coefficients. You had a
Yeah, I was
question?
just curious, like in '87, you had, I believe, Harry Markowitz with his S&P hedging program and became self-fulfilling. Did you make comparisons to situations like that in your studies?
We did not make an explicit comparison to that. Pete Kyle, who is one of the authors of this paper, was on the Brady Commission. So he was the person who was explicitly charged with evaluating the 1987 crash. And he didn't come up with that. So I guess that's why my memory is not long enough to sort of think of that. But one sort of thought that we did entertain is something I think along the lines that sort of somewhat of a larger question that I think that you're asking is that there is a degree of financial innovation, and a degree of financial innovation that especially that translates into some sort of arbitrage strategy, be it cross-market or within market, may translate or may lead to some sort of exacerbating event. And that is something I think that we do sort of try to find very hard.
Just going back to your previous comment, I was wondering if do you have any hypotheses on how these high frequency traders may avoid bumping into each other? I understand we don't actually know the answer, but it seems hard to get your head around how they might do that.
I really hope that there was no secret meeting in the Chicago hotel where they all sat down and said, let's do this. One possibility is that over time, certain strategies became dominant. And strategies that became dominant, such as the type of a trading head strategy that is being witnessed by these regressions, would typically put them all on the same side, so they wouldn't be bumping into each other.
So the 16 high frequency traders, their behavior is is very significantly similar to each other?
I cannot say that.
But they don't want to.
But when you categorize the traders, right? Do you like every day you recategorize them, or it's very stable? You don't really
It's very, very stable. But what we did for this day is that we looked at the high-frequency traders and intermediaries, is that we actually categorized them based on their trading behaviors 3 days prior to that. Because we didn't want our results on May 6th to be polluted by the fact that we actually made the categories to account for something. So we wanted to see if what they did on May 3 through 5 was actually quite different from what they did on May 6th. And we found that it was not. Now, those who happen to be falling into the categories of May 3 through 5 are pretty much the same who are in that category on May 6th. And they're pretty much the same who are in that category, substantial period before that.
But how about the fundamental buyers and sellers?
Those are different than every day. So you may be a fundamental buyer on May 5, on May 6 you're not even there. So you accumulated your position and you're not interested. So other categories are day specific.
Oh, okay, but they don't become like, wouldn't a fundamental buyer suddenly become an optimistic trader?
It could be reclassified as an opportunistic trader sort of on the next day. It's probably less likely because the level of sort of directional position is not really quite consistent with what opportunistic traders do. I mean, unless they have like balls of steel and want to sit on that exposure overnight. And these are significant exposures you really need to sit on, and then if you live on borrowed money.
Is it possible that leverage may play a big role to begin with?
Leverage is what?
Is it possible that leverage may play a big role in this situation?
Very much possible. One of the innovations. So futures contracts, by definition, are highly leveraged, right? Because you don't need to pay the entire amount; you just need to pay the margin. And so you can leverage, easily leverage 10 to 1. One of the interesting innovations that happened in the last few years is, of course, exchange-traded funds. Exchange-traded funds you can also obtain a significant degree of leverage with exchange-traded funds. So this cross-market arbitrage strategies that did propagate, seem to have propagated this sort of cascade, are a function of leverage. And I think that is something that we definitely need to look into, because ETFs are relatively recent, and that is sort of one recent arrival that probably requires significant attention. Also, most of the broken trades, about 60% I believe of broken trades happen in ETFs. So that's where the liquidity dried up the most as well. So they are quite a different animal. They're more a derivative-like animal. They're leveraged, and again, as a propagation mechanism, it's something that may be sort of a propagation mechanism of choice that happened on that day. Propagation mechanism of choice that happened in 1987 may have been something else. A propagation mechanism of choice, tomorrow might be yet something else. It may be like order submission strategies or something. One more.
The report took a while to come out. What possible reformatting of the data or what additional data would have made this easier analysis to conduct?
So the report took a lot to come out for a couple of reasons, 3 reasons really. So first reason, as I said, on the future side, we had the data 24 hours later. We had the preliminary analysis done 48 hours later. We had a preliminary report issued on May 18th. What did take a long time to do is to investigate several possible triggers. Because every time you think of a possible trigger, you need to really go and put together the data and see if it actually plays out in the data. Is it order submissions in the order book? Okay, let's go construct depth. Let's construct total depth for 500 stocks. Takes time to do, right? Did it happen and did it start in the mini or did it start in the spider? Is it liquidity replenishment points? Or is it rerouting? What is it? So every time you look at sort of triggers, you have to go. So there was, I can't say that there was one massive collection effort, but it was a collection effort that sort of consisted of sort of bits to evaluate different hypotheses. I'll really speak somewhat out of turn, but the SEC did come out with a request for information on the consolidated audit trail. And the consolidated audit trail would put them in a position that we are in now, where we have consolidated audit trail and we have consolidated audit trail coming to us as a feed. The price tag on that consolidated audit trail proposal is really quite substantial. And I think that you, the public, will need to really see, is that something that you think is something that needs to be done. So it's open to the public. There's a comment period. You can go and submit your comments to an open public box and say, no, I don't think SEC should have consolidated audit trail, especially if it's so expensive. What are you going to do with it? Or yes, I think you should have it, and this is why I think you should. I think two sort of directions in which we're going is, one is, yes, more data, smarter data, better data, more data that could help us analyze cross-market linkages in particular. Another direction is, let's understand algorithms better. And understanding algorithms better is a different kind of data. It is really qualitative data. And we are in a very active period right now of reaching out to market participants and learning from them what sort of strategies they pursue. So this is qualitative data. This is qualitative, let's call it information, that helps us then understand the execution patterns in the data that we observe. Because without it, if you just look at it, and it's a bunch of jagged lines. You need to put them together and figure out, is that normal? Is this abnormal? Are these people doing something they usually do? Or is this completely out of line? How is this algorithm behaving today? Why is it behaving differently than yesterday, right? So these are sort of the two broad areas of, quantitative data, and sort of understanding algorithmic strategies more broadly. Thanks for your time.